Hello, everyone, and welcome back to the GMS Weekly podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 15 of 2026, and for the first time in a while, it feels like something has actually shifted.
It does. And interestingly, that shift didn't come from the recycling markets themselves, it came from Washington. A delay in planned strikes on Iranian energy infrastructure, along with talk of productive discussions, triggered a sharp correction in oil prices.
And it wasn't a small move either. Brent dropped from above $109 per barrel to nearly 101, about an 8% fall in a matter of hours.
At the same time, though, freight markets are telling a slightly different story. The Baltic Dry Index actually pushed higher this week, climbing to around 2,139. So vessel earnings are still holding firm.
Which means owners still have an incentive to keep ships trading rather than sending them for recycling.
Exactly. And on the currency side, things were relatively stable. The dollar softened slightly, with the DXY just under 100, which offers some support to subcontinent buyers, but again, nothing decisive.
So when you put it all together, oil easing, freight firm, currencies steady, it feels like the market is shifting, but not quite enough to change behavior yet.
That's the key takeaway. The oil correction is important, but it's not yet decisive. Owners aren't going to react to a single week of volatility, and the backlog of tonnage from Q1 is still very much in place.
All right, let's move into pricing, because there are some notable shifts this week.
Bangladesh remains firmly at the top and actually strengthened further. We're now looking at roughly $460 to $465 per LDT for dry bulk, up to about $485 for tankers, and close to $495 for containers.
Pakistan holds second, steady around the mid-400s.
India remains third, broadly unchanged in the low 400s.
And Turkey still at the bottom, hovering around the high 260s to high 280s per LDT.
So the hierarchy hasn't changed, but the strength at the top, especially Bangladesh, is becoming more pronounced.
Let's start there.
Bangladesh had a standout week. Steel plate prices jumped sharply to around 71,000 taka per ton, one of the biggest single-week increases we've seen this year.
And importantly, the currency stayed stable.
Exactly. So that improvement flows directly into bidding capacity. That's why Bangladesh continues to lead as the most aggressive buyer.
And financing?
Improving. The letter of credit bottleneck from Q1 is clearing, and central bank approvals are moving faster, which is helping translate appetite into actual deals.
But there's still some caution.
Yes, mainly around compliance. Those sanctioned VLCCs sitting in Chattogram are now entering their fourth week unresolved, and they've tightened due diligence across the board.
So stronger pricing, better financing, but stricter scrutiny.
Exactly. And on top of that, the monsoon clock is ticking. With about 7 weeks to go, recyclers are under pressure to secure tonnage before conditions change.
So Bangladesh is ready, but still waiting for supply.
Precisely.
Moving to India, and it's a more mixed picture again.
Yes. The rupee gave back some of last week's gains, softening to around 93, which impacts bidding capacity.
Steel did move up, though.
It did briefly, touching around 41,000 rupees per ton, but those levels weren't fully sustained, and energy issues are still weighing on the market.
LPG disruptions?
Exactly. They're still affecting steel mills in Alang, which limits how much recyclers can really capitalize on improvements in pricing or currency.
Which is why India remains the lowest priced destination.
Correct. And once again, the core issue is supply. Alang has the infrastructure, the compliance credentials, over 100 HKC yards, but without vessels, that capacity remains underutilized.
So India is ready but waiting.
Exactly.
Now Pakistan, probably the most stable story this week.
That's right. The rupee held steady around 279, and steel prices remained firm at about 177,000 per ton.
Which creates a much more predictable operating environment.
Yes, and that stability keeps Pakistan firmly in second position. Structurally, it's also benefiting from Gulf proximity and a growing HKC-compliant base.
Although the oil move introduces a bit of uncertainty there.
It does. If tensions ease further, that Gulf advantage could soften. But for now, that's still a forward-looking risk.
So Pakistan is stable, competitive, but still dependent on supply.
Just like everyone else.
And finally, Turkey.
Turkey saw a slightly better week. The lira firmed modestly and inflation eased a bit, but structurally, nothing has changed.
Still uncompetitive on price.
Exactly. At around $268 to $288 per LDT, Turkey remains well below subcontinent levels.
So activity stays limited to the EU-approved niche.
Yes, regulated tonnage where compliance matters more than price. Outside of that, Turkey remains constrained.
Before we wrap up, let's touch on activity.
We did see one notable deal this week. An LNG vessel reported around $513 per LDT on an as-is basis.
And port movements?
India saw multiple arrivals and deliveries. Bangladesh had a few units moving through, while Pakistan again reported no new vessels.
So once again, supply remains limited.
Exactly. And that brings us to the key takeaway.
This feels like an inflection point.
It does. The war premium in oil has started to crack, and that opens the door for a potential release of tonnage.
But we're not there yet.
Not yet. Freight is still firm, owners are still earning, and supply hasn't responded.
So the market is still waiting.
And as always, it comes down to one question.
Not whether recyclers are ready.
But when owners will finally decide to act.
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights.
Until then, stay safe and see you next week.